Welcome back to the deep dive. We've just been digging into the latest from a real giant in the restaurant industry, Darden Restaurants.
Right.
This time, we're focused on their fiscal year 2026 Q1 earnings report, which covers how they did up to late August 2025.
Yeah, and this report, it's more than just numbers on a page. It really gives us a great snapshot of, how casual and fine dining are performing when people are watching their wallets so closely. Our goal today is really to figure out how Darden pulled off such strong results. They didn't just meet expectations, they beat them pretty significantly on same restaurant sales and earnings, even with commodity costs going up.
And those top-line numbers, they really do tell a story. Total sales jumped 10.4%, hitting $3.0 billion. But the number I'm looking at is the same restaurant sales growth, performance at existing spots. Up 4.7%. That's strong.
It is. And for investors listening, the adjusted diluted EPS, earnings per share, grew 12.6% to $1.97. That's a, very healthy return.
So they're definitely doing something right.
Absolutely. And what's really striking is how much market share they seem to be grabbing. We saw that the average casual dining chain had comp sales growth of about 5.0%.
Okay, wait. So the average was 5.0%, but Darden was 4.0%. How does that show share gain?
Wow, good question. Because the median performer, like the typical chain right in the middle, their growth was only 3.3%. That big gap between the average and the median tells you that while some big players might be pulling the average up, a lot of chains are struggling. Darden's 4.7% puts them way ahead of the pack, easily in the top quartile.
Got it. So the average is skewed upwards, but the typical experience is weaker.
Exactly. And their guest traffic numbers were even better, top quartile, maybe even top decile. They're pulling people in while others are losing them.
Okay, so let's get into it. Darden's got this huge range of brands. Olive Garden, LongHorn, Capital Grille, Ruth's Chris, Cheddar's. How do they maintain such strength across such different concepts? It can't just be random.
No, definitely not random. It really boils down to a core philosophy they call brilliant with the basics. It sounds simple, but it's about relentless focus on the food, the service, the atmosphere. But underpinning that are four very specific competitive advantages they lean on. Their sheer scale, their massive amount of data and insights, really rigorous strategic planning, and this is key, the quality of their people.
Brilliant with the basics.
Yeah.
Okay, it sounds good. But how does that actually, translate day-to-day into beating the competition?
Well, it translates through the managers and the teams and the restaurants. They actually just had their big annual conference for general managers and managing partners. The whole point is getting everyone aligned on priorities. And you see the payoff internally, too. They hit a new all-time high on their employee engagement survey this past quarter.
And they connect that directly to results.
Directly. They found a clear link. When restaurant leaders are highly engaged, you get fewer mistakes, the food's more consistent, service is better, and ultimately, guest traffic goes up. It all starts there.
Makes sense. Consistency builds trust. Okay, let's talk about the biggest engine in their portfolio, Olive Garden. It led the way with 5.9% comp sales growth. That's huge. What specifically worked there?
Olive Garden had a really interesting mix of strategies. On one side, they pushed bolder, spicier flavors. They introduced a new spicy 3-meat sauce for their create-your-own pasta platform. That platform starts at just $12.99, so adding this new popular flavor option really boosted an already strong value offering.
So leaning into value but adding excitement. But wasn't there also a premium push? I saw something about a Calabrian steak and shrimp dish.
Exactly. That's the other side of the coin. The Calabrian steak and shrimp bucatini was a limited time offer, definitely at a higher price point. But guess what? It ranked in their top 10 entrees for guest preference.
Yeah.
Massive hit.
So people were willing to spend more even while looking for value. How does that work?
It shows that value isn't just the lowest price, right? It's about the perceived value. The quality, the excitement, getting something special. That LTO gave people a reason to come in, a bit of an indulgence. And they balance that with a really smart affordability test they're running.
The lighter portion menu. Tell me about that. They took existing entrees, made them smaller, and charged less. Doesn't that just feel like less?
Well, here's the clever part. Yes, 7 existing entrees, smaller portions, lower price point available at dinner and all day on weekends. But and this is crucial, they still come with the unlimited soup or salad and breadsticks.
Okay, so you still get the unlimited stuff.
Exactly. The guest gets a lower entry price, maybe feels better about not wasting food, but they still feel like they're getting that classic Olive Garden abundance because the unlimited sides are still there. And the initial results are good affordability scores jumped 15% in the test markets. It's smart price management without making the plate look empty.
That is clever. Okay, shifting slightly. Delivery. Olive Garden's been pushing hard on its own delivery using Uber Direct. Who's ordering this way?
It's largely reaching people who, frankly, weren't coming into the restaurant much anyway. It's skewing younger, a bit more affluent people who really value the convenience of delivery right to their door. And importantly, these delivery guests tend to spend more per order, a higher average check.
They ran a big promotion too, right? That 1 million free deliveries.
They did, and during that campaign, their weekly delivery volume basically doubled. Huge spike.
But did it last? Often those promo bumps just disappear once the deal ends.
Some of it faded, naturally, but even after the promotion, their delivery volume stayed about 40% higher than before the campaign started. And they estimate about half of that lift is truly incremental business people who wouldn't have ordered otherwise. So it seems like the campaign actually built some new habits.
Interesting. Okay, let's pivot to another star performer. LongHorn Steakhouse. Always seems solid. They posted 5.5% comp growth, and traffic was up 3.2%. What's their enduring appeal, especially with beef prices being what they are?
LongHorn's magic is really its consistency. Quality, simplicity, culture, that's their mantra. They focus on doing simple steakhouse food, but doing it perfectly every single time. And consumers recognize that. In the Technomic surveys, they consistently rank #1 among major casual dining brands for food quality, service, atmosphere, and value.
All four. Wow.
Yeah. When people are nervous about spending money, they tend to go with brands they trust absolutely won't disappoint them. LongHorn has built that trust equity, especially in the steak category.
Makes sense. Okay, beyond the big two, there's the other business segment, Yard House, Cheddar's, Seasons 52. They grew comps 3.3%. What drove that?
It was really about each brand sharpening its specific edge. Yard House, for instance, doubled down on things that make them unique, like their taco platform. They upgraded ingredients using stuff like birria, cumin, chili shrimp, higher quality, more interesting flavors, and guests noticed preference scores went up. They also do internal things like a Best on Tap competition, which helps build that strong culture.
And Cheddar's.
Yeah.
They're known for value, right?
Exactly. Cheddar's is all about the wow price. They had a Hawaiian sirloin limited time offer for $16.49. That included a side and their famous honey butter croissant. That kind of aggressive value pricing earns them the top spot in Technomic for price and affordability. And it's helping their takeout and delivery to off-premise sales grew 15%, a lot of that driven by their own first-party delivery.
Okay, what about the higher end? Fine Dining Capital Grill, Ruth's Chris was actually slightly down, comps negative 0.2%. Small dip, but how did they respond?
Yeah, a slight softness there. But they reacted quickly. At Ruth's Chris specifically, they launched a short-term, 5-week, 3-course menu for $55. The idea was to give guests price certainty, take away some of the anxiety about the final bill. And it worked. It drove positive comps for Ruth's during that period. Shows even high-end diners appreciate a clear value structure sometimes.
So lots of smart moves operationally. But all this happened while costs were going up, right?
Right.
Let's dig into the inflation headwind. That seems like the biggest challenge they flagged, especially beef.
Yeah, that's definitely where the financial pressure is most intense. And this is where Darden's strategy gets really interesting, maybe even a bit contrarian. Management kept stressing their main goal is investing in the guest. So in Q1, they deliberately priced their menus about 0.3% less than their overall cost inflation.
Wait, they priced below inflation?
Below their total inflation rate, yes. And they signaled they plan to continue that, maybe even widen the gap in Q2, pricing about a full percentage point below inflation.
Okay, but doesn't that crush margins in the short term? How do they justify that, especially to Wall Street?
Oh, it absolutely squeezes margins right now, no doubt about it. But their argument is strategic. They believe keeping prices relatively lower than competitors, maintaining that strong value perception, is crucial for the long haul. They're playing a longer game, betting that this will help them hold on to guest traffic now and gain even more market share when the economy eventually improves or competitors raise prices more. It's a calculated risk, sacrificing some margin now for share later.
That's a gutsy call, especially since their cost forecast seems to be getting worse, not better. They mentioned beef specifically. Yeah. What's making steak so expensive right now?
Yeah, they had to raise their forecast for commodity inflation for the whole year, up to 3.0% to 4.0%. And they said it's mostly because of beef, especially the expensive cuts like tenderloin and ribeyes, and also some impact from shrimp tariffs. The beef issue is mainly supply. There have been cutbacks by the big meat packers. Imports from Mexico were halted because of a screwworm issue.
Screwworm, okay.
Yeah, apparently. And then fewer imports from Brazil due to tariffs. So you have tight supply hitting steady demand, and prices just shoot up.
With supply being that tight, do they think these high beef prices are here to stay?
Management seemed pretty convinced that these price levels aren't sustainable in the long run. They think the consumer just won't bear it forever. They actually pointed to some early data showing what they call demand destruction starting to happen at the retail level, like grocery store sales of beef volume dipped slightly in the latest numbers.
So people are buying less beef at the supermarket.
Right. And the theory is if demand starts to fall there, eventually that pressure works its way back up the supply chain and wholesale prices should hopefully ease off. They're basically betting on a market correction.
Okay, so balancing strong Q1 performance against these rising costs.
hmm
How does all this shake out in their guidance for the rest of the fiscal year? Are they still confident?
They seem very confident, actually. They raised their outlook for total sales growth for the year, now expecting 7.5% to 8.5%. They also tightened up their expected range for same restaurant sales growth to 2.5% to 3.5%. That confidence comes partly from the strong Q1 beat, but also because they're speeding up new restaurant openings, planning around 65 new locations this year.
This strong quarter for Darden fits into a broader trend, doesn't it? Why is casual dining overall holding up relatively well right now compared to maybe other segments?
Yeah, it's a good question. A couple things seem to be at play. One is relative value. Casual dining generally hasn't pushed prices up quite as aggressively as, say, fast food or even some fine dining, so it feels like a better deal to many consumers. And the other factor is the experience. People still want to connect, go out with friends and family. Casual dining hits that sweet spot. It's affordable enough for many, but still feels like a proper going out occasion.
And who is driving this traffic? Is it specific income groups?
What's really fascinating is that Darden said their casual dining brands saw traffic increase across all income groups, every single one. So that suggests you've got maybe some higher income folks trading down from pricier options, and at the same time, lower income consumers are really drawn to the strong value propositions, like at Olive Garden or Cheddar's. It's hitting multiple demographics.
Interesting. One last thing, there's always buzz about new weight loss drugs, the GLP-1s. Did Darden mention any impact from those, like people eating smaller portions?
They touched on it briefly. Their perspective seems to be that, yeah, maybe some people on these medications eat less overall or order smaller portions when they eat. But critically, when these consumers do decide to dine out, they often still choose casual dining for the social experience, the atmosphere. It's less about just the volume of food and more about the event itself. They also kind of mention a broader trend of maybe less snacking in general.
Right, the overall occasion still matters.
Exactly. So pulling it all together, the big takeaway from this deep dive is seeing a company like Darden really leverage its massive scale and sophisticated data. They're navigating this tricky environment by being smart about pricing, using things like portion control and targeted premium items while tackling these big commodity cost surges head on. And their core strategy seems clear. Prioritize that long-term perception of value for the guest, even if it means taking a bit of a margin hit right now.
That focus on long-term value perception really stands out. And you see it in the details, right? The fact that a higher-priced dish like the Calabrian steak and shrimp can be a hit at the same time they're testing lighter portions really shows that value isn't just one thing. It's complex. It's about quality, experience, and price all mixed together. And one point management made really stuck with me, that the difference in performance between regions often boils down to the quality of the local leadership, the GMs and managing partners. That focus on local execution being the real competitive edge, even in a giant standardized company. Well, that's pretty powerful. So that leaves us with a final thought for you to chew on. Thinking about that emphasis on local leadership, what other industries, maybe ones that seem really standardized on the surface, could actually benefit the most by shifting their focus? By realizing that maybe their biggest competitive advantage isn't the corporate playbook, but the strength and consistency of their leaders on the ground.